Hello, it's What Would Peter Lynch Do?
Yeah.
Today is May 29th, 2025. Market-wise, the index closed higher today, mostly thanks to the strong performance of NVIDIA. So today we got this question from a listener, and it's a good one. They asked, what is an earnings announcement, a conference call? How does it affect stock prices? That's a fantastic question, really, because these moments, they're just, well, absolutely crucial in investing. We've dug into the material you shared to really get a handle on this.
Yeah, definitely crucial. And understanding earnings, it's not just about tracking daily stock moves, It's fundamental. It's about evaluating a company's actual value, which is exactly what Peter Lynch was focused on.
Right.
Think of it like getting a proper look at the company's health report. You're figuring out if its long-term prospects line up with its current stock price. Solid, growing earnings, that's the bedrock, the intrinsic value.
Okay, so why does digging into these numbers, looking under the hood, why does it matter so much?
Yeah.
Especially if you think like Peter Lynch, focused on the long haul.
Well, what's fascinating here is that earnings analysis helps you see if a company is actually making money. And just as importantly, how efficient it is. Are sales growing? Are they keeping costs in check? This gives you real insight into whether the business itself is, getting stronger over time. Lynch was always looking for companies with improving fundamentals and earnings. Well, they're often the clearest signal you get.
Right, like checking if they're actually getting better at what they do, not just riding some wave of hype. And does it help spot potential problems early, too?
Oh, absolutely. Looking at things like debt levels on the balance sheet or checking if the business is consistently burning through cash, that can definitely flag risks before they blow up into full-blown crises. Lynch certainly wasn't keen on overly leveraged companies unless he really, really understood the situation. It's all about understanding that financial foundation.
Okay. Now, the market, it seems to get really worked up around these earnings announcements. We hear all about earnings beats and earnings misses. Why is the reaction often so, well, dramatic?
Yeah, that's a really important point. The material you provided highlights something key. The stock price reaction isn't just about the raw numbers the company reports, like are they profitable or not. It's largely about how those numbers stack up against what the market expected.
Okay. So analysts create these forecasts, right?
Yeah.
A consensus. And the market kind of prices that expectation in ahead of time. So the surprise is the difference.
Precisely. Exactly that. If a company comes out and reports earnings that are significantly better than that consensus expectation, that's your earnings beat, it basically signals the company's doing better than everyone thought.
Right.
That's new positive information. So the stock price typically jumps, sometimes quite quickly, to reflect this, revised outlook.
And the flip side, if they miss.
Well, a miss means the results were worse than expected. That's seen as negative new information. It suggests the company's path, its trajectory, might not be as strong as the market hoped. So yeah, the stock price tends to fall. It's really the surprise factor relative to those expectations. That drives a lot of the short-term volatility you see around earnings season.
I remember reading Peter Lynch himself talking about sometimes being boggled by stocks going down on good earnings news or up on bad news just because of these analyst expectations.
He did. He saw those as, well, frustrating short-term anomalies. He definitely acknowledged their impact on stock prices right then and there in the immediate term. But his focus, it always remained steadfastly on the long-term performance of the actual business underneath. He wasn't really trading on beats or misses. He was investing based on the company's fundamental ability to grow its earnings over years.
Okay, so if we want to look past that short-term noise, analyze a company like Peter Lynch might, what exactly should we be looking at in these earnings reports and announcements? Where do we start?
Right. You start with the official filings. In the U.S., public companies file quarterly reports. That's the Form 10Q, and an annual report, the Form 10K. These contain the financial statements. That's key.
The big three, right? Income statement, balance sheet, and cash flow statement.
Yeah.
How would someone thinking like Lynch approach these?
Yeah. The big three, think of them as different windows looking into the company's health. The income statement, that shows profitability over a specific period, sales, costs, and ultimately the profit. Lynch would look for consistent sales growth. Are they selling more?
Okay.
And are they controlling costs effectively? This links directly back to his 5 ways a company can boost earnings, things like selling more in existing markets or reducing costs.
Okay, so income statement, profitable, growing sales.
Yeah.
Got it. What about the balance sheet then?
The balance sheet, That's more like a snapshot. What the company owns its assets versus what it owes liabilities, and then the owner's stake the equity at one specific moment in time.
Snapshot, right.
Lynch would definitely use this to check the financial stability. Is there too much debt? You might look at the debt-to-equity ratio. Does the company have enough liquid assets, enough cash or near-cash stuff to cover its short-term bills? A strong balance sheet means the company's got a solid foundation, It has the resources to actually execute its plans rather than being constantly stressed out by debt.
And the third one, the cash flow statement, tracking the actual cash moving in and out.
Yeah.
I've heard that's especially important, maybe more so than just the profit number.
Oh, it is. And perhaps even more critical from that practical business perspective that Lynch really appreciated. See, the income statement can show a profit on paper, maybe due to accounting rules.
Right.
But the cash flow statement shows if they are generating actual cash from their core operations. Is real money coming in faster than it's going out from the main business? Positive operating cash flow is like the lifeblood. It's the cash they can actually use to reinvest, pay down debt, maybe pay dividends. It's the fuel needed to execute those growth plans we keep mentioning.
Got it. Okay, so numbers on paper versus actual cash in the bank. Huge difference. Beyond the main statements, are there specific metrics or ratios that can quickly signal something important?
Ratios can definitely offer a quick comparison point, but remember, context is absolutely everything. Lynch didn't invest just by plugging numbers into formulas. But yeah, he looked at things like the price-to-earnings ratio, the PER, basically how much you're paying for each dollar of earnings. A lower PER might suggest value, but you'd always compare it to the company's growth rate. He famously liked the PEG ratio, that's PER divided by the earnings growth rate.
Ah, the PEG ratio. Heard of that.
Yeah. He also looked at things like return on equity, ROE. That shows how efficiently the company is using shareholder money to generate profit. A consistently high ROE. Well, that could indicate a really strong business model, but again, context.
Okay, so analyze the statements, check some key ratios for context, and then comes the actual earnings announcement itself, often followed by that conference call. What's the real point of the call? Isn't all the info in the report?
Well, what's really fascinating here and crucial is that the conference call adds the context and the company's story on top of the numbers. Management gets on, they discuss the results, they explain why things happened the way they did.
Okay, the why.
Exactly. And critically, they usually provide guidance. That's their forecast for the future. And this guidance is incredibly important because it effectively sets new expectations for the market.
So it's not just looking back at the last quarter's numbers, but it's what the company thinks is coming next.
Precisely. If management sounds confident, if they guide higher than analysts were expecting, that can really drive the stock up, even if the quarter they just reported was maybe just okay,
Interesting.
And conversely, if they sound hesitant or they guide lower than expected, the stock can fall, even if they technically had an earnings beat for the past quarter. It's where you get insight into their strategy, how they actually plan to implement Lynch's 5 methods for increasing earnings, cutting costs, raising prices, expanding markets, selling more, or, dealing with those losing operations.
And you can sort of hear it in their voice, maybe, hear if their plans sound realistic, or get a sense if they're actually working.
That's a big part of it. And the Q&A session on those calls is vital. Analysts dig in, they ask really detailed questions that can reveal nuances about the business, the competition, maybe challenges that aren't immediately obvious just from reading the press release.
Right, the tough questions.
Yeah. You get a sense of management's confidence, how well they understand their own business, and importantly, whether their strategy makes sense and seems to be succeeding. This ties directly back to Lynch's advice. Find out the company's plans and then check if they're working. The call helps you do that checking.
Okay, so wrapping this part up. While the short-term market reaction gets all the headlines, driven by that surprise factor relative to expectations, a long-term investor, thinking like Peter Lynch, uses these earnings reports and the conference calls to really evaluate the underlying business.
Exactly.
Are they executing their strategy? Are they truly growing earnings sustainably? Are they financially sound? Is the story holding up?
That's the essence of the deep dive. It's moving beyond just the headline beat or miss. It's about understanding the whole story that the numbers and the management commentary are telling you about the company's past performance, its present health, and crucially, its future potential. It's about seeing if the actual business is progressing in a way that's likely to build that intrinsic value over time.
Okay, great. So let's recap quickly. We've explored why analyzing earnings really matters for long-term investing, looked at how to approach financial statements and key metrics through that Lynchian lens. We talk about the vital role of conference calls in understanding the company's plans and their outlook, and also why the market reacts sometimes wildly to beats and misses based on new information hitting expectations.
And we've tried to tie it all back to Peter Lynch's core wisdom. Look beyond just the reported numbers, understand the company's strategy for actually increasing earnings, and then, this is key, diligently check if those plans are succeeding. Remember his 5 basic levers: cutting costs, raising prices, expanding into new markets, selling more where they already are, and turning around or getting rid of losing operations. That framework helps you evaluate if a company is truly improving its core business.
Right. And, I'll say a word from Lynch today and say that this principle is connected not only to investment decisions, but also to life wisdom.
Ah, interesting connection.
Yeah, think about it. Just like we analyze a company's plans and check if they're working, we can kind of look at our own goals and efforts.
Yeah.
Are we reducing costs as things that drain our energy or time? Are we increasing the value of our skills? Maybe expanding our market by learning new things or meeting new people? Are we selling more of our product by, applying ourselves effectively? Or are we dealing with our own losing operations, maybe bad habits or situations that just aren't serving us well?
Huh. That's a neat parallel, applying fundamental analysis to life.
Kind of. It's all about identifying what's working and what's not, so you can build long-term value, whatever that means to you in your own life. Just a thought to leave you with. Okay, that's our deep dive for the day. See you next time. This was Men Radival. What would Peter Lynch do? Thank you for joining us today. Have a nice day.